Hello everyone! Welcome to our latest deep dive into the Metro Vancouver real estate market. For over 3 years now, we've witnessed a landscape dominated by falling prices, weak sales volumes, and buyers largely holding back, cautiously waiting on the sidelines. But lately, the chatter has changed. We're starting to see some early, rather surprising shifts prices, showing nascent signs of stability, new listings beginning to ease, and even the so-called smart money making massive long-term bets on the housing industry. Are these the early tremors of a market bottom, or merely a temporary pause before another descent? Today, we're dissecting the numbers, deciphering the signals, and breaking down easily what this means for you, whether you're a buyer, seller, or investor across Metro Vancouver and the entire country. Stick with us because the details we're about to share could profoundly impact your next real estate decision. Before we dive into the specifics, if you're contemplating a move in this dynamic market, whether you're looking to purchase your dream home or sell your current property, now is the time to ensure you have expert guidance. Reach out to me directly, scan the QR code for my contact information, or you can find it in the description. Let's discuss your unique situation and how we can navigate these interesting times together. Let's kick things off with a significant development that many believe marks a turning point in housing confidence, Berkshire Hathaway's colossal bet on the housing industry. Warren Buffett's firm, now run by Greg Abel, has acquired a U.S. homebuilder Taylor Morrison in a massive all-cash deal worth $6.8 billion. You might wonder why a U.S. move matters here in Canada, but its significance could be profound. Berkshire Hathaway is known for thinking in decades, not months or quarters. This acquisition signals their long-term conviction that despite current high interest rates, affordability concerns, and a soft housing market, the fundamental strength of housing remains incredibly robust. Why this confidence? Firstly, much like Canada, the US faces a persistent housing shortage, particularly in affordable segments. Years of structural undersupply relative to population growth and household formation mean there simply aren't enough homes being built. Secondly, Berkshire adheres to the classic Buffett principle buy when others are fearful. Current housing sentiment is far from euphoric, market rates are elevated, buyers are hesitant, and builders face slowing demand. Yet, Berkshire views this as temporary pain, not a permanent weakness. This is classic value investing, acquiring quality assets when others are cautious. Finally, this isn't their first rodeo. Berkshire already owns major housing related businesses like Clayton Homes, deploying nearly $7 billion in cash during uncertainty from one of the world's most disciplined capital allocators strongly suggests they believe current housing weakness is cyclical, while demand over the next 10 to 20 years is structural. This follows similar moves, like an investment firm in Toronto recently investing $500 million into bulk buying condos, signaling long-term upside potential in the Canadian market. These big institutional bets are signals we haven't seen in years, and they warrant close attention. Next, let's talk about a technological shift poised to reshape home financing. TD Bank's introduction of agentic AI into its mortgage and home equity line of credit application review process. This isn't your typical chatbot. Agentic AI is like a highly capable assistant that can independently complete sequences of tasks with minimal human involvement. In TD's case, this AI is now classifying borrower documents, extracting financial information, calculating income, validating figures against lending policies, conducting consent checks, flagging discrepancies, and ultimately generating concise application summaries for underwriters. The speed improvement is dramatic. A mortgage application review process that historically averaged 15 hours can now be completed in under 3 minutes. For borrowers, this means quicker approvals, less waiting, and greater certainty during a typically stressful process. For real estate professionals, it could reduce financing delays, firm up deals faster, and create more predictability. For lenders, it's about operational efficiency at scale. While human underwriters are disappearing, TD emphasizes oversight for privacy, security, fairness, and accountability. AI is clearly taking on the heavy lifting. TD frames this as just the beginning, a step towards an end-to-end transformation of its real estate lending business. In a market where speed can be crucial for securing a property, financing timelines matter immensely. If AI significantly reduces delays and improves accuracy, the mortgage experience will look very different in the coming years. Now, let's turn our attention to the pre-sale market in Metro Vancouver, particularly for large concrete high-rise developments. If you want to understand the current difficulties facing these developers, consider this startling statistic. Metro Vancouver saw zero concrete high-rise pre-sale projects launched in the first quarter of 2026. Not fewer, not slower, zero. To put this in perspective, last year in the same quarter, there were roughly 152 units launched across one or two buildings. This represents a complete freeze in one of the region's most vital housing segments. These concrete towers, typically located in prime urban areas near transit and employment hubs, are essential for absorbing long-term population growth. When their launches cease, it creates a ripple effect on future housing supply. The slowdown is largely due to current unaffordability and challenging financing conditions. Most projects require 60 to 70% of units to pre-sell before developers can secure construction financing. This threshold is incredibly difficult to achieve today, deterring developers from risking significant time and resources. This is compounded by an estimated 4,000 newly completed and unsold condo units in Metro Vancouver, creating a backlog of inventory. Developers are adapting, seeking creative financing, or shifting to townhomes or multiplexes, which offer quicker turnaround times. The irony is that today's slowdown is actively creating tomorrow's shortage. Industry experts warn that the collapse in presale activity could lead to a significant housing shortage around 2028 to 2029 or even 2030, as real estate is a slow-moving industry where shifts take years to materialize. Looking at national home price trends, we find ourselves in truly unique times. From 1980 to 2022, national home prices never experienced back-to-back years of decline. They rose 8 out of every 10 years, with an average increase of 6% annually. However, since 2022, we have now seen 3 consecutive years of national home price declines, making this a 45-year outlier scenario. The big question is when or if this trend will shift. The Bank of Canada, meanwhile, appears to be in a tough spot. Market predictions for rate hikes have shifted, with a 96% chance of a hold at the upcoming June 10th meeting and a 97% chance of only one hike by December. This signals a move towards stability, possibly due to concerns about a technical recession. Now, let's get into the crucial May 2026 real estate statistics for the Greater Vancouver area. Last month, 2,140 homes traded hands, a modest 1.5% increase month over month, marking the highest sales volumes of 2026 and since October 2025. However, year over year, sales were down 3.5%, and we are still trending 26.5% below the 10-year average. In fact, May sales were the lowest on record for the month of May, excluding only the lockdown month of May 2020. Even during the deep global financial crisis in May 2009, 65% more homes were sold. Year to date, we are tracking the slowest real estate sales in 26 years. This contrasts with some realtors reporting their best month in years, suggesting a market where only the top 5% are thriving, leading to a 15% drop in active licensed realtors. There are nuances, however. The single-family detached market in the city of Vancouver is showing more resilience. Sales for Vancouver detached homes were up 38% year over year, and Vancouver Westside saw an astounding 57% increase. This explains why some realtors focusing on these specific segments report a busier market, while the broader regional data reflects significant weakness. Moving to new listings, May saw a 9% decrease month over month and a 7.6% decrease year over year. This follows a clear trend over 3 straight months where listings have topped off and are now lowering, returning to long-term averages after running well above them for the past year or two. Inventory levels, while still high at 16,300 active listings, are showing signs of absorption, down 7% from last year. While still 35% above the 10-year average, the trend suggests that the peak of inventory might have been in 2025 for this cycle. This could be due to sellers holding back, unwilling to list in a weaker market. The sales to active ratio, a key temperature gauge, sits at 13.1% overall, relatively unchanged. Breaking it down, detached homes are at 11% firmly in a buyer's market, townhomes at 16% up 1%, and apartments at 14% down 1%, trending towards a buyer's market. This is reflected in deals where many sellers are making significant concessions. Foreclosures continue to rise with 564 active foreclosures across southern BC, predominantly in the detached market. This is more than double the number from 2 years ago, although the rate of increase has slowed for 2 consecutive months. Days on market have increased to 22 days, though some properties take much longer. Now for prices, often the most scrutinized element. The Home Price Index HPI for Metro Vancouver rose 0.2% last month, marking the second increase in 3 months, reaching $1,170,700. While year over year, HPI is down 6.2%, prices have essentially been flat for the past 5 months, following 12 consecutive months of declines. This stability, or rather flattening, is a new development. Median prices, however, are a different story. They've increased for 5 consecutive months, up $87,600 during this run, and are now only 2.5% below their all-time high, currently at $975,000. Average prices also rose for the second month in a row, up $19,000 to $1,237,000. So in May, all three price metrics showed increases, an interesting turn given the broader context. Comparing property types, detached benchmark prices in Vancouver have dropped significantly from their May 2022 peak of $2.1 million to $1.85 million, a loss of nearly $150,000 in 1 year. Townhouses have seen drops, though less dramatic, while condo prices are effectively back to 2018 levels, a mind-blowing fact. This is due to weak condo sales and a large supply of generic units, where price becomes the main differentiator. When comparing 2026 to 2025, a year that was already the worst for Vancouver real estate in over 2 decades, 2026 is currently shaping up to be even worse. Inventory levels are rising month over month, while sales remain flat or slightly higher. Months of inventory for May 2026 is almost at 8 months, the highest in a decade. Sales figures for 2026 are generally lower than 2025, with the gap widening in May, suggesting the spring market boom many hoped for did not materialize. The good news is that new listings are lower in 2026 than 2025, possibly because some sellers cannot afford to sell at current prices or are simply waiting for better conditions. Prices have remained flatter in 2026 compared to 2025, which saw more significant declines. For condos, the downward trajectory continues, reflecting market weakness. While detached sales showed a stronger start in March and April 2026 compared to 2025, the gap closed significantly in May, with only 6 more detached homes sold this May. Townhouse and condo sales remain slower in 2026 than in 2025. On the rental front, nationally, rates have fallen by about 4.7%, with Vancouver seeing a 5.3% year-over-year drop. BC Premier David Eby recently claimed credit for these declining rents, attributing it to government interventions. However, a more accurate assessment points to federal government decisions, specifically a significant reduction in immigration, temporary foreign workers, and non-permanent residents, leading to an outright contraction in Canadian population growth, a historical first. Additionally, the CHC rental financing program, offering 95% loan to value and 50-year amortizations, has incentivized developers to build a record number of new rental units. With pre-sale condo launches frozen, building rental housing has become the only game in town, leading to a glut of supply that continues to push rents lower. Finally, the City of Vancouver is proposing a new policy called Vancouver Villages, which would rezone 13,000 property parcels for 4 to 6-story buildings in certain pockets of the west side and east side. This aims to densify and create more walkable communities, effectively reducing the overall stock of single-family housing over time. While this might suggest increased land values for these newly zoned properties, the current market reality is different. With so much new zoning across the city, example TOA areas, Broadway plan, and the worst pre-construction market in decades, developers have ample options, removing much of the scarcity premium. Therefore, significant land lift from these rezonings is unlikely in the near term, a pattern also seen with multiplex zoning where land values are actually declining. The resilience of entry-level detached homes in desirable Vancouver neighborhoods stems from their increasing scarcity as the city continues to densify. In summary, the Metro Vancouver real estate market in May 2026 presented a complex picture. While overall sales volumes remain historically low, making 2026 worse than the already challenging 2025, and prices for many property types continue to bleed lower year over year, we also observe some intriguing signals. Big institutional players like Berkshire Hathaway are making long-term bets on housing, and TD Bank is transforming mortgage approvals with AI, promising greater speed. The critical pre-sale market for concrete high-rises has completely frozen, foreshadowing future supply shortages. Interestingly, some price metrics like median prices showed month-over-month increases for several consecutive months, and sales in specific segments like Vancouver detached homes performed relatively better. The rental market is experiencing significant declines due to reduced population growth and a surge in new rental construction, while new zoning initiatives aim to densify the city, though without immediate land value uplifts. Canada is officially in a recession, and the Bank of Canada is signaling rate stability, all contributing to a market that is consolidating, with considerable ups and downs still expected in the short term, but with long-term structural demand indicators providing a foundation for investor confidence. If you're grappling with these complex market dynamics and wondering what they mean for your personal real estate goals, I'm here to help. Whether you're looking to capitalize on current opportunities as a buyer or strategically position your property for sale, don't navigate this market alone. Call or text me today for a personalized consultation. Scan the QR code on screen for my contact details, or you can find it in the description below. Thank you for watching, and we'll see you next time.